The stock market is currently closed, and as of the final closing bell on Friday, July 10, 2026, Navitas Semiconductor closed at $13.47 per share. This represents a significant intraday drop of 5.01% from its previous closing price of $14.18, with the stock trading between a low of $13.17 and a high of $13.79 throughout the session. Trading volume was notably elevated, with over 11.14 million shares changing hands, showing intense investor debate. The prevailing market expectation is that this specialized chip maker is poised to easily ride the coattails of giants like NVIDIA stock as data centers demand more power infrastructure. However, the harsh reality confronting investors is a sudden and complex legal battle, as rival Wolfspeed recently filed a comprehensive patent infringement lawsuit targeting the core product lines that make up the vast majority of the revenue for this enterprise. This unexpected legal hurdle has introduced massive uncertainty just weeks before the company is scheduled to report its second quarter financial results on July 27th, creating a sharp contrast between long-term promise and immediate operational risk. When you look at the general sentiment across popular investing sites and retail chat rooms, the narrative surrounding this company is overwhelmingly focused on the massive global shift toward gallium nitride and silicon carbide technologies. The common belief is that because these advanced materials allow power supplies to operate much faster and cooler than traditional silicon, the company is guaranteed a slot in the next generation of fast chargers, electric vehicles, and artificial intelligence servers. Many retail traders using the Robinhood app or setting up basic individual brokerage accounts view the recent price pullbacks as a golden opportunity to accumulate cheap shares, assuming the secular growth trend will lift all boats. But if you look deeper at the institutional positioning and technical health, the reality falls far short of this optimistic thesis. Professional asset managers who allocate capital through complex systems like Fidelity Wealth Management or select specific assets for Fidelity ETFs are pulling back, focusing heavily on the underlying cash burn, structural dilution, and the defensive legal expenditures that are now required to protect the company's proprietary designs. To understand the recent stock movement, we have to look closely at the daily swings and the sheer velocity of the recent downward trend. Over the past month alone, the stock has shed roughly 41% of its value, experiencing a brutal slide that has caught many self-investing participants off guard. This was not just a slow bleed, it has been characterized by sharp, high-volume sell-offs followed by weak, low-volume bounces. For instance, just a few days ago, the stock tumbled over 12% in a single session following fears regarding broader capital expenditure rollbacks among major technology firms. While some observers using an intelligent portfolio approach hoped that the drop was merely a healthy sector reset, a major technical warning sign appeared when the 20-day moving average crossed decisively below the longer-term averages, signaling a strong bearish crossover. When a high beta asset shows this kind of technical damage on high volume, it typically indicates that large institutions utilizing sophisticated tools like the Interactive Brokers platform are actively reducing their exposure rather than buying the dip. Compounding these technical breakdowns are intense macroeconomic and sector-wide pressures that are weighing heavily on all speculative semiconductor equities. The broader sector has been highly sensitive to changes in sentiment, especially after mixed reports from major international foundries raised concerns about the sustainability of massive infrastructure spending. Hedge funds and large institutional investors have been net sellers of technology hardware for several weeks, and high-beta power semiconductor plays are often the first assets to be trimmed when risk management models flash yellow. Investors monitoring their accounts through SoFi Invest or looking at online investment trends can see that when the general semiconductor index ticks down slightly, smaller, non-profitable component developers suffer double-digit stumbles. The reality of the current macro environment is that interest rates and capital costs remain high enough that Wall Street is no longer willing to give early-stage chip designers a free pass on cash conservation, preferring instead to park capital in proven free cash flow positive megacaps. Another critical piece of the puzzle that is keeping a lid on any potential recovery is the company's ongoing capital-raising activities, specifically their $125 million at-the-market stock offering program. While having access to capital is important to fund research and development, the practical reality of an active at-the-market offering is that it creates a persistent supply overhang in the public markets. Every time the stock attempts to mount a meaningful rally on positive industry news, the potential for new share issuance acts as a built-in mechanism for diluting existing shareholders and capping near-term upside. For anyone managing their individual retirement accounts through Fidelity IRAs or seeking general investment help on asset allocation, this structural dilution is a vital factor to track because it alters the long-term earnings per share math quite drastically, even if the top-line revenue numbers continue to scale upward as projected. Comment below how many shares of Navitas Semiconductor you currently hold in your brokerage account, and let me know if you think this patent dispute will end in a settlement or prolonged litigation. To properly evaluate where the business stands today, it helps to step back and look at what they actually build and how their business model operates. Established in the mid-2010s and headquartered in California, the company focuses exclusively on next-generation power semiconductors, moving away from old-school silicon to champion gallium nitride and silicon carbide. Their core product portfolio includes branded families such as GaN Fast, GaN Slim, and GaN Safe, alongside their silicon carbide lines known as GeneSiC and CPAC. These chips are designed to handle high voltages and currents while minimizing energy loss, making them highly attractive for mobile fast chargers, renewable energy systems like solar inverters, and the onboard chargers found in electric vehicles. On paper, their addressable market is directly tied to secular expansion trends, including the long-term production schedules of companies like Tesla stock and the power efficiency needs of consumer electronics firms like those driving demand for Apple stock. The company operates a fabless model, meaning they design the chips and outsource the actual heavy manufacturing to third-party foundries, which theoretically allows them to remain asset-light and scale up production without building multi-billion-dollar fabrication plants. However, older financial reports and past performance data show that turning these high-tech designs into a sustainable, profitable business has been an uphill battle. Looking back at the historical quarterly reports, the company has managed to grow its top-line revenue sequentially, moving from around $7.3 million to over $8.6 million in recent quarters. Yet this revenue growth has come at an incredibly high cost. Research and development expenses have surged dramatically, often exceeding $14 million a quarter, while selling, general, and administrative costs have also ballooned. As a direct result, operating losses have widened significantly, with recent quarterly net losses expanding from $19 million to over $33 million. This persistent cash burn means that the company's current ratio and quick ratio, while still indicating adequate near-term liquidity, are under steady pressure, forcing the management team to rely on share-diluting capital markets to maintain their balance sheet cushion. For retail investors reviewing their balances via the Robinhood stock trading platform or analyzing financial statements on Interactive Brokers trading tools, these metrics reveal a stark divergence between the exciting technology narrative and the sober financial reality of a company that is still far away from generating positive net income. Looking ahead, the future outlook for the stock hinges on a few critical scenarios and upcoming catalysts that will test the expectation versus reality framework to its absolute limit. The most immediate catalyst is the upcoming second quarter earnings release on July 27th, where executive management will be forced to address both the financial trajectory and the structural risks facing the enterprise. Wall Street analysts are deeply divided on what happens next, with 12-month price targets ranging wildly from a conservative $9 to an optimistic $21 per share, reflecting total disagreement over the company's execution path. The optimistic optimistic view assumes that the company will successfully expand its footprint in the lucrative AI data center power supply market, winning new customer designs and rapidly scaling shipments to offset the slowing demand in the legacy consumer electronics and electric vehicle markets. If the company can prove that its Silicon Carbide and Gallium Nitride chips are being adopted by Tier 1 server manufacturers, the stock could easily stage a powerful short covering rally, validating the original thesis held by many who manage their funds through a SoFi trading platform or use self-directed investing accounts. Compounding these technical breakdowns are intense macroeconomic and sector-wide pressures that are weighing heavily on all speculative semiconductor equities. The broader sector has been highly sensitive to changes in sentiment, especially after mixed reports from major international foundries raised concerns about the sustainability of massive infrastructure spending. Hedge funds and large institutional investors have been